Forget what you're hearing on the news about why crypto is moving. The real story isn't just about Bitcoin ETFs or some new killer app. It's about something much bigger. The most powerful force in finance, the Federal Reserve, has begun to turn on the taps, setting the stage for a tidal wave of capital into the markets. In this video, I'll show you how the Fed's recent policy shifts in 2025 are the prelude to a potential crypto explosion that most people won't see coming until it's already happened. This isn't about chasing the latest meme coin or getting swept up in the daily drama. This is about understanding the one macro truth that has driven every major bull market of the last decade. It's the hidden engine behind those parabolic price charts, the invisible hand that decides if we get a crypto winter or a golden summer. And right now, that engine is starting to rev up for what could be its most powerful run yet. The mainstream media will be late to this story. They'll report on the effects, the soaring prices, the new all time highs, long after the cause has been set in motion. But by the end of this video, you'll understand the cause. You'll see the blueprint. Let's be honest. For the average person, the crypto market can feel like navigating a hurricane in a rowboat. One day, a new project is the future of finance, and its token soars 50%. The next, a regulator halfway across the world sneezes, and the whole market dips 10%. We're bombarded with conflicting headlines, analyst reports that say one thing on Monday and the exact opposite on Wednesday, and a constant flood of social media hype promising that this one altcoin is the next 100x. This is the noise. It's a non-stop, disorienting racket designed to trigger your FOMO and your panic. It keeps you glued to the charts, making emotional moves, buying the top of a local pump, and selling the bottom of a manufactured dip. The whole system is built to distract you from the one signal that cuts through all of it. While everyone is busy arguing about Solana versus Ethereum or getting shaken out of their positions, they're missing the big picture. They're staring at the leaves on one tree, completely unaware that the entire forest is about to get flooded. The problem is, we've been conditioned to look for a specific, tangible reason for every market move. We want to believe Bitcoin is going up because a big company bought some or because a new ETF was approved. And while those things do have an impact, they're secondary. They are ripples on the surface, not the tide itself. The tide, the deep, powerful force that lifts all boats, is liquidity. And the one entity that controls the global liquidity tide more than any other is the US Federal Reserve. This creates an us versus them dynamic. You have the mainstream story, the day-to-day chaos that keeps retail investors guessing. And then you have the people who understand how the financial system actually works. They know that what the Fed does with interest rates is infinitely more important than any single piece of industry news. They're not playing checkers, reacting to every little move. They're playing chess, looking at the macro level strategy that controls the whole game. This video is your invitation to join that second group. It's about stepping back from the noise and focusing on the one signal that has historically been the most reliable predictor of massive crypto rallies. That anxiety you might be feeling, that sense of stagnation in your portfolio, that's a direct result of the Fed's policy over the last few years. They intentionally starve the market of money to fight inflation. But that chapter is closing. The game is changing, and the Fed has already made its first moves. To understand where we're going, you have to know where we've been. For the past couple of years, we've lived through a deliberate, calculated period of financial starvation. This wasn't an accident, it was a policy choice. To battle runaway inflation, the Fed used its biggest weapons, hiking interest rates at a historic pace and a strategy called quantitative tightening, or QT. Think of it like this: the global economy is a giant field, and money, liquidity, is the water it needs to grow. The Fed controls the main water valve. To stimulate growth, they open it. To slow things down, they crank it shut. For the last couple of years, the Fed didn't just turn the valve down, they had it almost completely shut off. Raising interest rates makes water more expensive. Suddenly, it's costly for businesses to borrow and expand, for families to get a mortgage, or for investors to take on risk. At the same time, quantitative tightening was like actively siphoning water out of the field as the Fed was letting bonds fall off its massive balance sheet. This two-pronged attack, expensive money and less of it, created a huge liquidity squeeze. You felt the effects. Your savings account might have earned a little more, but your investments probably felt stuck or went down. The cost of everything from car loans to credit card debt shot up. In that environment, cash is king. Why risk money in a volatile asset like crypto when you can get a relatively safe, guaranteed return from a government bond? This is the risk-off world the Fed wanted. Capital fled from the frontiers like tech stocks and crypto and ran to safety. The field went dry. But here's the critical piece of the puzzle: this policy has a time limit. The Fed cannot keep rates high and liquidity tight forever. Why? Because of debt. The United States government is sitting on a mountain of debt that has climbed to over $38 trillion dollars and is growing at a breathtaking pace. Think about it. If you have a huge credit card balance, a rise in interest rates is painful. But if your balance is in the trillions, a rise in interest rates becomes catastrophic. At a certain point, just paying the interest on the national debt becomes one of the government's biggest expenses. To stop the whole system from collapsing under its own weight, the Fed is eventually forced to lower interest rates. It's not really a choice, it's an inevitability. They have to make the debt cheaper to manage. They have to turn the water back on before the whole field turns to dust. They painted themselves into this corner. They had to fight inflation, but doing so lit a time bomb on the global debt pile. The only way to defuse it is to reverse course and flood the world with cheaper money again. That is the pivotal moment we are standing at right now. This brings us to the heart of the argument, the catalyst that's set to ignite the next big rally. The Federal Reserve hasn't just stopped tightening, they've started to reverse course. This isn't a hopeful guess, it's happening. As of the fall of 2025, the Fed has already cut interest rates twice, lowering them to a range of 3.75% to 4%. And the quantitative tightening program, which was pulling money out of the system, is set to officially end on December 1st, 2025. So, what happens when the Fed cuts rates and stops QT? It's the direct reversal of that liquidity squeeze. This is the how it works part, the mechanics connecting a decision made in Washington, D.C. to the price of Bitcoin on your screen. First, when the Fed cuts rates, it kicks off a domino effect. Holding cash becomes less attractive overnight. That risk-free return you were getting starts to shrink. This pushes investors to look for other places to make their money work, places with higher potential returns. Analysts call this the hunt for yield. Second, and this is crucial, borrowing gets cheaper for everyone. Imagine you're a big hedge fund. When rates are high, borrowing to invest is expensive. But when the Fed cuts rates, it's a green light. They can now borrow millions or even billions at a much lower cost. That new capital doesn't just sit there, it floods into the market looking for a home. Where does this tidal wave of new money go? It flows straight into what Wall Street calls risk on assets. These are assets that do well when there's a lot of money sloshing around the system. Think tech stocks, emerging markets, and most importantly for us, crypto. Bitcoin, as an asset with no earnings or dividends, is arguably the ultimate risk on asset. It is incredibly sensitive to these global liquidity flows. This isn't just a theory. Macro analysts have shown that the crypto market acts as a high beta investment, reacting strongly to money flowing into global markets. Macro investor Raoul Pal has even built a model around this global debt cycle. His analysis suggests that as trillions in debt need to be refinanced, central banks will be forced to provide massive liquidity. And for every $1 trillion injected, risk assets like crypto could see a major boost in value. We could be looking at a monumental tailwind for Bitcoin. On top of that, you have what some analysts are calling stealth quantitative easing. They're watching things like the Fed's repo facilities, arguing they could be used to quietly inject liquidity to manage the growing US debt, all without big QE headlines. It's a quieter way of opening the floodgates, but the effect is the same. More money in the system, all of it looking for a return. The stage is being set, and crypto stands to be a primary beneficiary. If you're finding this kind of deep dive analysis valuable and you want to understand the macro forces that actually move markets, make sure you subscribe and hit that bell icon. We're not here for fleeting trade signals. We're here to give you the framework to see the bigger picture. The information we're about to get into is what separates casual observers from prepared investors. Now, let's look at the proof that this isn't just a theory, but a recurring pattern. A good thesis is one thing, but one backed by hard evidence is another. This link between Fed easing and crypto rallies isn't a new idea. We have a perfect recent case study that shows this in action with stunning clarity: the bull run of 2020 and 2021. Think back to March 2020. The world was in chaos and markets were in freefall. In response, the Fed and other central banks unleashed the largest monetary stimulus in history. They cut rates to zero and launched a massive quantitative easing campaign, the infamous money printer go brrr era, injecting trillions directly into the system. They threw the liquidity floodgates wide open. What happened next? Exactly what our thesis would predict. A torrent of capital desperate for a home outside of zero yield cash poured into risk assets. The stock market went on a tear. And Bitcoin Bitcoin went on one of the most incredible runs in its history. From a low of under $5,000 in March 2020, its price skyrocketed, eventually peaking near $69,000 in November 2021. This wasn't a coincidence. The correlation was incredibly strong. If you overlay a chart of the Fed's balance sheet, a direct measure of the money they were pumping in, with a chart of Bitcoin's price, you'd see two lines moving with a stunningly strong correlation. As liquidity expanded, Bitcoin's price rose. When the talk of tightening started, the rally cooled. This direct relationship is one of the most important laws of physics in the modern crypto market. The data is clear. Research has shown Bitcoin's price moves in the same direction as global liquidity trends a huge amount of the time. Bitcoin has become a unique barometer for global financial liquidity, but the pattern goes even further back. Some macro analysts see it in what they call the 65-month liquidity cycle. This is a niche theory based on Fourier analysis that tracks a recurring 5.5-year pattern of capital flow. According to this framework, we are in the upswing phase of a new cycle that began after the low point in late 2022. Projections based on this model suggest the next major peak for global liquidity could be in the first half of 2026. This tells us that the current Fed policy shift isn't just an isolated event, it's part of a larger predictable cycle. We saw what happened during the last peak in 2021. Now, with the Fed once again preparing to open the spigots, history is giving us a clear roadmap. Of course, there are nuances. Some analysts point out that the timing of these cycle peaks can vary and corrections are always possible. But the overarching trend, the fundamental direction, remains clear. The conditions look strikingly similar to 2020, and the historical precedent is undeniable. We've seen this movie before. While the Fed's policy shift is the main engine, what makes this moment so unique is that this engine is being dropped into a completely upgraded vehicle. Several other powerful catalysts are all converging at the same time, creating a perfect storm that could make this next run even more explosive. The first, and maybe the most significant, is institutional adoption. Back in 2020 to 2021, big money getting into crypto was a wild, fringe idea. Today, it's becoming standard practice. The game has been completely changed by the launch and success of spot Bitcoin and Ethereum ETFs in the United States. These aren't just another financial product. They're a regulated, insured, and dead simple bridge connecting the vast ocean of traditional wealth to crypto. For the first time, pension funds, corporations, and conservative retirement savers can get exposure to Bitcoin with a click right from their existing brokerage accounts. The numbers tell the story. While daily flows can be volatile, with both big inflows and outflows, the overall net inflows into spot Bitcoin ETFs have been substantial. This creates structural demand, a persistent bid for Bitcoin that simply didn't exist in previous cycles, providing a stabilizing anchor during pullbacks. The second, often overlooked catalyst is what I call the AI liquidity pump. The biggest tech companies in the world are in a full-blown arms race to build out the infrastructure for artificial intelligence. They are spending tens of billions of dollars every single quarter on a massive build-out of data centers, chips, and energy. This isn't just a tech story, it's a liquidity story. That colossal spending doesn't vanish. It flows through the global economy. It pays salaries, funds supplier companies, and juices the earnings of the biggest stocks on the planet. This acts as a massive parallel form of liquidity injection, running alongside the Fed's easing. It creates wealth, boosts market sentiment, and adds to the overall risk on mood where assets like crypto thrive. So, picture it. You have the Fed, which has already started cutting rates. At the same time, you have the new institutional grade on ramps of the Bitcoin ETFs, ready to channel a portion of the world's wealth into the market. And in the background, you have the AI boom pouring massive amounts of fresh capital into the global economy each quarter. It's not just one tailwind, it's three hurricane force winds all blowing in the same direction. This is the confluence of catalysts that makes the 2025 to 2026 window arguably the most bullish setup in crypto history. Knowing a tidal wave of liquidity is coming is the most important step, but knowing a wave is coming and knowing how to surf it are two different things. This won't be a straight lineup. The market will be volatile with plenty of dangers for the unprepared. This is where we move from thesis to strategy. First, you've got to be aware of crypto-specific risks. While the macro trend for Bitcoin is incredibly bullish, the story for many altcoins is more complicated. A huge overhang is token unlocks. Many projects have massive amounts of tokens for early investors and teams that are scheduled to hit the market throughout 2025 and 2026. This creates creates predictable selling pressure that can drag down a price even in a bull market. You have to do your homework on vesting schedules. Second, pay attention to capital rotations. Even in a broad bull market, money moves in waves. We've seen periods where Bitcoin pulls back while a more traditional safe haven asset like silver rises. This can be a sign that smart money is rotating into safer assets before moving back out on the risk curve. Don't be surprised to see these divergences. The key is to tell the difference between a short term rotation and a change in the long term trend. Finally, be wary of liquidity sweeps. As the market trends up, big players often orchestrate sharp, sudden price moves designed to trigger the stop losses of retail traders. They'll push the price just below a key support level to cause panic selling, or just above resistance to trigger FOMO buying, only to reverse it immediately. In a market driven by massive liquidity flows, these moves will be common. The lesson? Avoid placing your stops in obvious places and wait for confirmation before jumping on a breakout. Your greatest weapon in this market won't be speed, it'll be patience. This isn't about day trading the chop, it's about positioning yourself to ride the bigger, more powerful trend. Let's bring it all together. The narrative is clear, compelling, and backed by a mountain of evidence. The Federal Reserve, cornered by a global mountain of debt, has begun a new easing cycle. Their rate cuts in 2025 have already started, and the end of quantitative tightening is here. History shows us, with a powerful correlation, that when global liquidity expands, Bitcoin doesn't just rise, it goes parabolic. This macro cycle is the engine. But this time, that engine is supercharged. For the first time, we have regulated institutional ETFs acting as a massive on ramp, ready to funnel unprecedented capital into the asset class. This is the fuel. The stage is set, the script is written. While the mainstream media is fixated on the daily noise, the fundamental forces that truly drive markets are aligning for a historic move. The great liquidity squeeze is ending, and a new era of expansion is beginning. That capital has to go somewhere, and a significant portion is going to find its way to the scarce digital global assets of the crypto market. The only question left is whether you'll be positioned before the rest of the world finally catches on. What is your strategy for this coming liquidity wave? Are you preparing your portfolio? Let me know your thoughts and your price targets for Bitcoin in 2026 in the comments below.